Hello everybody, it's been a crazy September, right? But as usual, August to September is always a very good period to do your shopping for risky assets. So while other people do their shopping in December for Christmas, I do mine in September and August for risky assets. And this year is similar, and I bought two REITs, Ames and Starhill. So in this video, let's go through my thinking process and how I prepared for the volatility. This is the performance of the STI for many years. You can see August is always very rough. It's always very volatile and very big negative numbers. September might be a bit better, but you can see that the big moves can also happen in September, right? Which is the reason why I say this period is always a very good period to do bargaining for risky assets. If you look at the magnitudes experienced during the GFC period, this is truly life changing, man. Of course, people will also remember the period of COVID, right? 18% sell off. So if you look at the volatilities for these two periods, actually what happened in September is nothing, it's peanuts. The REITs have underperformed STI though, which comprises a lot of banks which benefit from the interest rate hikes. You can see the A REIT, Maple Trees are down like 5 to 6%, and KDC really took it on the chin, right? Down 12%. I talked about the KDC in another video. I'll put the link over here. It's called Technical Analysis of KDC. So if you look at the video, my conclusion is that the KDC is extremely interest rate sensitive. Right? It pretty much tracks the 10-year US Treasuries. So it's a very good bond proxy. So it works well in a rate cut cycle, but it also suffers from a rate hike cycle. So if you're interested, you can look at that video. But for this year, I was preparing for what I thought would be a sell-off. Because there was an FOMC, and I thought the Fed would be hawkish, and therefore things would just sell off. So I made a video about it actually. So I'll put the link over here and you can check it out. It's got the Fed fund rate at 4.6% and how to prepare for it. So in that video, what I did was basically to compare a bunch of REITs and their valuations in 2022 versus that in 2018. So in 2018, there was a rate hike cycle as well, right? So that was the last rate hike cycle. So I wanted to see how things have changed, and this is the summary of the table actually. So you can see these are the bunch of names for the REITs, and I left out a couple of names like CICT, FLCT, Escort, and MPACT, because these REITs have gone through mergers, right? So comparing them now versus 2018 is not meaningful anymore, right? So like for example CICT, if you compare CICT to CCT and CMT back then, well, it's not very comparable anymore, right? So I left those names out. Of course, the new REITs listed after 2018 are not included. So this is the summary of the table. You can see these are the names, and this is the price of 2018. This is the yield that the market demanded of the REITs in the last rate hike cycle, and this is the valuation from a PB perspective in the last rate hike cycle, and these are the 2022 metrics from DPU and NAV wise. So the DPU is an estimation because I have no idea what the full year DPU will turn out to be, but this is the best case guess I think. And using these two metrics, I wanted to find out what would be the price of this REIT given this year's DPU and 2018's valuations. And this is the result. So this column is the price of the yield. So if I take DPU in 2022 and I divide it by the yield that the market expected in 2018, I end up with one price. And this column gives you the price to book, which is price number 2, which is the NAV in 2022, multiplied by the price to book in 2018, and end up with this number. And this is the average, right, of these two numbers because they are different. So I wanted to use this table to guide me from a quantitative level of the price level that I wanted to buy at, since the valuations here are more strict, right? Because in 2018 the markets were worried about the rate hike cycle, and therefore the yield demand from the markets were high, right? So these are the prices that I end up with. So for a margin of safety, I wanted to take the lower of these two valuations. So whichever is the lowest, I will use it as the price point entry level. And I was targeting the lower of these two to the average as my price target. And actually I was quite frustrated by the movements for quite a while because they're actually not moving much at all post FOMC. So in one of the videos I was talking about why wasn't the REITs correcting to more like a 6% level, right? So something like a 10-year treasuries plus 2%, right? And finally something actually happened, and that was the week of 25th September. I think the trigger was because of the Liz Truss government and their mini budget. And after that, there were expectations of the BOE to raise rates to like 6% to combat the fall in the sterling, right? And the 10-year UK gilt yield actually rose to 4.5%, higher than the 10-year US Treasuries of 4%. I think that might be the trigger, but I'm not very sure though, because it can be some other factor, right? Like liquidations and margin selling and so on and so forth. I'm not sure why, but eventually it happened. And on the 26th of September, things started to correct quite a fair bit. So I decided that I wanted to fire my bullets away. And in this month, I prepared my cash and I divided it into three bullets to be fired away. So on the 26th of September, AIMS was at 129, so that was quite close to 127, right? I don't think I wanted to buy Suntech because the gearing was quite high, right, more than 40%. So I decided to leave out the Suntech. Starhill was 57, and that was actually at my targeted level. Keppel 104, and my target was 101. So quite clear, quite near, but not there yet. AREIT 275, my target was 247. MLT 161, target 142. MIT 244, target 226. KDC 181, target 157. CLCT was actually 104, lower than 1.1. But then the CLCT in 2018 is quite different from the CLCT now, right? Because of the COVID strategy in China. So, well, I thought it's not very comparable either. FCT 223 versus 1.8. Actually, for FCT, I was targeting $2 as well. Because, well, I think it's a good reader. So, actually, as of the 26th of September, only AIMS, Starhill, Keppel Reit, and FCT was somewhat near my level. Oh, actually, sorry, FCT was not even near this level. I was targeting 1.8 to 2. So actually, only 3 REITs were close to my targets. So AIMS, Starhill, and Keppel. So I also included the FLCT here because FLCT was not in this table because back in 2018 it was still FLIT and FCOT. But still, I like FLCT though. I think it's a very good REIT, well run with a very conservative balance sheet. So it was also not near my price level. So in the end, I decided that I have to fire first bullet, either AIMS or Starhill or Keppel Reit. And in the end, I decided AIMS it is then, and I've bought it at 129 at on the 26th of September. And then after that, I waited, and then I fired my second bullet at Starhill Global on the 28th of September, so 2 days away, right, in the morning at 54.5. And quite heartbreakingly, half an hour later, things just started to collapse all of a sudden out of the blue. You can see that everything just dropped like 2% across the board, right? In just half an hour after I bought my Starhill Global, it went from 54.5 to 52.5. So I just lost 5% of my money in 30 minutes, right? That was crazy. But anyway, I fired 2 bullets out of 3 and had just 1 bullet left. And I wanted to see if anything will correct even more. Maybe there'll be a bigger sell-off or whatsoever. So actually things really did soften after that. And KDC actually went to 166. FLCT went to 118. So I was deciding whether or not I should buy more AIMS at 125, more Starhill or FLCT or KDC actually. But the problem is that the KDC and the FLCT, they have a European exposure, right? And I wasn't really very keen to take on European exposure at this stage. So I thought, given that everything was setting off, I'll just buy the things without a European exposure. So either AIMS, so it's Singapore and Australia, right? Or Starhill, which is Singapore, Australia, and Malaysia, and a bit of Japan and China, right? So in the end, I decided I'll just buy Starhill then. And I bought it on the 30th of September at 52.5 cents. And that was my 3 bullets fired away at AIMS and Starhill. If you look at the metrics for AIMS and Starhill, of the price that I bought them at the 129 and 54.5 cents, actually it's pretty good value, right? Because the yield is more than 7%, and the price to book is below 1 as well. For Starhill is a 0.7 and AIMS is a 0.9. Quite cheap, I think. Most importantly are the metrics though, because I wanted to buy REITs which is well handled to weather the rate hike storm ahead. And so I wanted the REIT with a high fixed debt ratio and low percentage of debt maturing in the next 2 years. So if the Fed start to hike rates continuously for the next 2 years, actually having a fixed debt ratio protects you from the rate hikes. And since very minimal of your debt is maturing, then the refi problem will also go away. So I think these two REITs are actually quite well positioned to handle the rate hike shocks ahead. Especially for AIMS, right? Look at the AIMS. Only 4% of the debt is due for the next 2 years, and the fixed debt ratio is 88%. And quite importantly also, for these two guys, a lot of their properties are in Singapore, so I'm pretty well shielded from the European problems and the consequences of the Ukraine-Russia conflict, right? So if you look at the debt maturity profile for Starhill Global, it's pretty well managed, right? Low debt maturity for the next 2 years, 93% fixed debt ratio. For AIMS, actually it's even better, only 4% for the next 2 years maturing, and 88% on the fixed debt ratios. So I was quite happy with the ability of these two REITs to weather the rate hike shocks, and the yields were looking really, really attractive, right? And that completes my purchases for August and September. If you look at the calendar ahead, I think there's more volatility though. There's FOMC 1st and 2nd of November, and then 13th to 14th of December. Expectations right now, I think, for Fed to raise 75 basis points here and 50 basis points here. So, well, if they appear to be more hawkish than what is expected of the markets right now, there might be more volatility ahead. But I think it's always a good practice to just buy when the valuations are right. Because one thinking that people might have is that you should just wait for the bottom and then you start buying, right? But the problem is that when do you know it's the bottom? And next thing you know, if you're not careful, things just rally away if there's some sort of a positivity, and then you end up not committing your capital when the valuations were right already, right? So anyway, that's my purchases for September in this year. So good luck ahead for the FOMC's next two FOMCs ahead.